Here's how the top 1% manage their money. I'm Charlene. I worked in banking and wealth management in London with the world's wealthiest and had a front row seat to see how the wealthiest build and protect their fortune. So let's break it down for you. First off is the wealthy always think longer term. So it's not about quick wins at all. It's about making decisions that will pay off about 10, 20, or even 50 years from now. It's about not panicking during market dips, staying focused on the big picture and letting your investments grow over time. For example, in the banking industry, typically the length of time an investor expects to hold an investment is called one's investment time horizon. There are three types of investment time horizons. Short term, 1 to 5 years, medium term, 5 to 10 years, and long term is typically seen as over 10 years. By having a longer term view, you can usually ride out the financial market ups and downs and avoid panic selling when the market dips. Which leads me to number 2, delayed gratification. The wealthy are playing a very long-term game, so they understand the importance of looking out for their future selves, like years and years from now, versus succumbing to every want of their current present day self. As an example, business owners, small business owners, reinvesting their profits back into the business to fuel longer term growth of their assets in the future, instead of taking out the profits now to enjoy in their current present day self today. Similarly, and this can be applied to anyone, which is when a person can see their investment portfolio doing well or their savings account going up, and can choose to keep reinvesting so that their future self can benefit instead of cashing out on the gains early to satisfy the present day self. Number 3, diversification. Every investment book, guru, wizard, everyone seems to say diversify, but what does that actually mean? So the wealthy understand the principle of diversification, which essentially means they don't put all their eggs in one basket. Diversification in this case means spreading money across asset classes like real estate, stocks, businesses. And it can also mean spreading investments across different geographic locations, so different countries like US, UK, Asia, across the world. And diversification can also mean spreading your investments across industries. So for example, like tech, telecoms, health, consumer goods, all these different industries, these different sectors. This way, if one investment dips, the others are holding strong. So diversification essentially just helps you spread out your risk and therefore reducing the volatility that you can see. So how can I diversify? One could diversify by not relying on just one stock or one investment or one country, one location, or even relying on just one income. So if you're investing, ask yourself, are you diversified? Number 4, compounding. So the wealthy make use of compounding, and they know that compounding is when your money starts making money on its own. Effectively, this is when people say, make your money work for you. You're not just earning interest or returns on your initial investment, you're also earning interest on the interest itself. Over time, this can create a snowball effect where your wealth can grow faster and faster. So for example, say you invest $1,000 and in the first year you earn, say, $100 in returns, to keep things simple. And you keep this $1,100 invested throughout year 2. So in year 2, now instead of just earning returns on the original $1,000, you're earning interest on the $1,100 in year 2. And it keeps growing from there. Wealthy people invest early and consistently, letting compounding work its magic for decades. They're not jumping from one stock to another, trying to hit a jackpot. They're focused on long-term investments like stocks or real estate that consistently grow over time. Next is protection. No, I'm not talking about bodyguard protection, but many of the wealthy protect what they've built through insurance, whether that's health insurance, life insurance, or even mortgage insurance. In my view, getting insurance early on is key so that if something happens, like say an illness or an accident, like life happens, like we don't know what's coming around the corner sometimes. And the wealthy know that they'll be covered if they have insurance, and it won't wipe out their wealth if some unforeseen circumstance comes their way. On the flip side, it's also very interesting that it's actually a very costly mistake when the wealthy avoid insurance or think about insurance too late. For example, in some cases, if you don't have insurance and then you get ill, unfortunately, there are a lot of insurance companies out there that will see you as uninsurable. So you won't be able to get insured after you get certain illnesses. It depends on the insurance company, it depends on what the illness is, depends on the circumstance, but that is a possibility that I've seen where people fall ill, then they look to get insurance, but they're not insurable anymore and they have to foot the bill. So that's why taking out insurance early on can be a good thing. Number 6 is having an emergency fund. I know I keep talking about emergency funds all the time, but even the wealthy have emergency funds. So emergency funds aren't just about having a safety net, it's also about peace of mind, and that can be incredibly freeing mentally for everyone. In my view, you never know when life is going to throw you a curveball, whether you lose your job or something breaks or just something unexpected happens. And having liquid cash on hand means that you can handle about anything without dipping into your investments or retirement accounts. Now, for an emergency fund, the general guidelines say to typically keep about 3 to 6 months worth of living expenses in a high yield savings account. But for me personally, 3 months is a bit too little. I would aim for 9 to 12 months for peace of mind if you can. Now, don't get me wrong, if your emergency fund has 3 months worth of living expenses, that's a great start. But to me, why I think 3 months is too little is that because say you lose your job, it might take you more than the 3 months to find a new job. And that can also put a lot of pressure on yourself. So I would say have a minimum of 6 months living expenses. But if you can, have about 9 to 12 months of living expenses, purely because you don't know what's coming around the corner. And also for business owners, and if you're self-employed or you're looking to work on a business or a side hustle or something like that, the income isn't always guaranteed. So you might want to have a little bit more buffer in case something happens. Number 7 is separating your business and your personal expenses. Now, I think this can be applicable to anyone, regardless of wealth level, income level. If you have a business, make sure you separate the business and personal expenses. Now, one thing I saw over and over in the banking world is that wealthy people or small business owners, whatever spectrum you're on, always do this. They always separate their business and personal expenses. Now, separating business and personal expenses can help you to, one, keep things organized. It is a bit of a mess if you are at the end of the tax year trying to find out what you spent on your business, what you spent personal, and it becomes a bit of a mess. Also, number 2, it saves you time later sifting through all of your accounts and bills to see what is a business expense and what isn't. It can make accounting so much easier, and if you have an accountant, it can make your accountant's life much easier. If you're doing the accounts yourself, this can make your life so much easier too. So whether you have a separate business account and separate personal account, so keeping things separate. Number 8, having more than one bank account. Now, the wealthy typically don't rely on just one account or just one bank. They usually have more than one bank, so that's in the industry called multi-banked. What does this mean in simple terms? It means that they spread their money across multiple bank accounts to avail of different rates or different offers, and also to spread the risk. Like if something goes wrong with one bank or one account, then there's a backup. Here's an example. Now, at home in Ireland, there was a major bank called Ulster Bank, and they closed down operations in the Republic of Ireland in 2023. And because of this, a lot of people had to find a new bank, and there were relatively few bank options in Ireland. Now, if one already had another account with another bank at the time, you could simply just transfer funds from the bank that was closing to your second bank. But say you only had that one bank account in Ulster Bank and they closed down, you would have to go through the process of opening a new account, then transfer, then closing the old account, switching it over, all of that kind of nonsense. And it was a bit more of a hassle. Also, if you're just traveling and you lose one bank card or your bank card gets stolen, you have another account and a bank card so that you're not stuck. Next is being tax efficient. Okay, so this one is huge, guys. So the wealthy effectively look at how to be as tax efficient as is possible, or maximizing their personal allowances, or making use of the tax efficient schemes and products that are in their respective countries. So for example, making use of ISAs in the UK or Roth IRAs in the US, or even in Canada, the TFSA, I believe. So it's useful to look at how to get money working for you while also being tax efficient. So in the UK, most people can hold cash investments in an ISA, which means that your money can grow tax-free. But while 42% of the UK population have an ISA, 58% don't. And those people could be missing out on these savings. So the equivalent of an ISA in the UK in the US is a Roth IRA. So check what is available in your countries, because each country will have their own products, their own systems as well. Number 10, estate planning. Are you planning for the future? Well, the rich, the wealthy, they do that early. Estate planning is all about making sure one's money, their assets, their wealth, what they own, effectively transfers to the next generation as smoothly as is possible. So think things like having a will in place, trusts, and having conversations early on about how to divide money when people pass away. It's all part of the longer term strategy, the longer term vision for how to create a legacy and plan succession planning effectively. Now, something that anyone could really do is thinking about having a will in place to make sure money and assets like houses can flow as smoothly as possible to the next generation when someone passes away. That could be key. In case you don't know, a will, it effectively says what you want to happen when you die. It basically outlines what you want to happen to your stuff after you pass away. In the case of like having a will, usually most people don't really want to think about when they're going to pass on, but it's actually an incredibly empowering conversation to have, to know that your next generation, the people around you, the people you love, are going to be taken care of once you do pass on, which is kind of inevitable, I think. Interestingly, over half of UK adults, about 51%, don't have a will in place. Now, according to a study here, the main top worries for not having a will is leaving loved ones a ton of paperwork to deal with, believing the estate or the money won't be divided up as the person would have liked, that the estate might take a long time to resolve, and it will create arguments. All valid points if you don't have a will in place, so it might be worth looking into if you're looking at succession planning, looking after the next generation, that kind of thing. Number 11, philanthropy, and that can be giving to charity. Now, people donate to charities not only because it's for a good cause, that is also a very good reason, but it might be tax efficient for the charities themselves. For example, if you check out the gift aid scheme in the UK. And finally, ask the experts. The wealthy are not afraid to ask for help when it comes to money. The wealthy don't do it alone, and you don't have to either. There are experts that people can explore and look into, like accountants, tax advisors, financial planners, for example. Now, do your own research on who you speak to, because it completely depends on your situation and the needs that you have. I might have talked about this before, but in the UK, there's a website that I've used called unbiased.co.uk, where you effectively answer a couple of questions and you get matched to an expert, whether that's an accountant, broker, financial advisor, that kind of thing. And you can, in the UK, in some cases, get a free first consultation. It depends on the provider. So if you're in the UK and you're looking for an advisor, that could be a good shout. So these are ways that the world's wealthiest manage their money. If you found this video helpful, hit the like button, bell button, and subscribe for more on how you can master your money and energy. See you in the next one, guys. Bye!